So today on the agenda, we'll talk about things that impact the variable rates and how does it work, really, because there's a lot of questions about how that works, right? So we'll talk about that. We'll talk about the advantages of differences between variable rate versus fixed, which is also very important for us to outline. We're going to keep it really point form with these sorts of things. The third thing, we have some simulations. I don't think it'd be a meta mortgage meeting without some calculators. So I'll share the screen, and then Matt and I will talk through some of these numbers so that you guys can see how that pertains and how that would really affect numbers, right? Because I think visually it always makes better sense. I know comprehension for me, if I see it visually, it's much better. So we tend to do that in every one of our meetings with our clients. So we'll do that again today. And then the last part of our information is going to be about what to do, some recommendations of things that we're recommending clients typically right now to do with their variable rate mortgages, and with the whole variable rate topic in general. Okay, so why don't we start? Actually, no, I'm supposed to actually do another thing. Actually, Matt and I did a little bit of a dry run, nothing really straight up, but Matt, I do have to introduce Matt because a lot of people may not have known or got to meet Matt. Matt started at Meta last June, and we're super happy to have him on board. He started as a mortgage associate, working on intaking documentation, helping out on all the back end, putting files together. He has tons of experience with client relationships, and recommending client solutions in his past. So well over 15, 20 years of doing that. And then he jumped into the mortgage realm and loves it. I'm putting words in your mouth, but I know you love it because you have a passion.
This is fantastic. I mean, I'm just gonna sit back and let you say.
There you go. And then so now Matt is helping out with the portfolio, and he's helping out recommend. He's fully licensed as a mortgage agent within the team. So I figure rather than you hearing me speak the whole time, it's important to have someone else's perspective as well. So that's why Matt's on the call as well. So Matt.
Definitely. Yeah, it's a great team to be a part of. Obviously, you all know that. That's why you've, I think, given the confidence that you have into the Meta group as a whole, the whole team, starting with Vince, of course, and then we've got a hell of a team that runs on the back end. And I recognize a lot of these names. I know I've spoken to some of these names, whether it be via email or quickly on the phone. But it'll be nice to kind of do an informal conversation like this, and to be able to know that it is an accessible topic that we should know a little bit more about. It affects hundreds of thousands of dollars in everybody's individual lives. So this is a good thing to be a part of, and I'm happy to be here. I'm happy to be a part of this, and thanks for taking the time this afternoon to be a part of it with us.
Absolutely.
Yeah.
Okay, so let's start. Matt, I guess what we'll do is we'll talk about, I guess these, how does this all work, right? How does the variable rate change? That's one of the big questions that we get, right? Typically.
Definitely. Yeah, a lot of questions that'll come through is, obviously one of the things that comes to fruition a lot here is that you see a lot of these changes in your everyday payments and what will become new changes realistically moving forward. And you hear a lot of things surrounding the Bank of Canada. And it's something that we might take for granted in our world, just because it's something that we speak to and see literally every day for hours a day. But I think it would be smart. I think it would be prudent to at least have you speak, if you can, for a couple minutes on that, Vince, with what does the Bank of Canada influence in the way of the variable rates or rates they're in moving forward?
Yeah, and we're going to keep it really light because anything involving government and policy can get really dry and boring. So we'll try not to do that to you guys today. But basically how it works, how I explain to clients is that the variable rate has a correlation with what decisions the Bank of Canada makes with regards to fiscal policy. So the Bank of Canada meets periodically throughout the year. I'm going to show you guys very quickly just a little bit of a screen share for those of you who can see it. If not, I'll just speak to it as well. And basically what that is it talks about the number of changes that are done, or policy revisions that are done on an annual basis. It's 8 times a year. So you will see the Bank of Canada does meet 8 times a year. We have a Wednesday, April 13th. So in 2 days, they're going to meet again to discuss what they're going to do with what is called the key overnight lending rate. Okay, so the key overnight lending rate is really the rate that affects prime. Prime is the base rate that the variable rate is really based on. So most of you, pretty much everyone on the call who has a variable rate has a variable rate of prime less a factor that we've been able to negotiate for you with the bank. And so prime will move up and down periodically. Now, it doesn't mean that every time that the Bank of Canada meets here that there's a change. Okay, you'll see that the last meeting there was a change. There was an increase by 1/4 point. So that's 0.25 of 1%, right? It's a 1/4 point. When you hear people say 1/4 point or 25 basis points and percentages can be confusing for people, but that's really 0.25%. Okay, so if your rate is 2%, then that would mean that your rate would go up to 2.25%. That's the 25 basis points. Okay, so and prior to this, we had pretty much almost about 1.5 years of no changes at all in prime, right? So the Bank of Canada would still meet throughout the year periodically, but they didn't make any changes. Okay, so I figure what's really important here, let's actually show a graph. I wanted to show a graph to everybody. Matt, I don't know if you think it's a good idea, but we prepared a graph.
I'm the same graph here now, and I think it helps to really highlight where we are now, and especially in relation to where we've been, and not all that long ago. And I don't think there's obviously a lot of chatter, a lot of talk, media-based componently at least, that speaks to where everything is and what one should be doing, and a lot of maybe unfiltered biases in that respect. But I think that this graph definitely speaks to where we are currently in relation to where we've been historically, and how we're still extremely low, remarkably low, all things considered.
Yeah, so here you can see this is from 2000. So we can take a look at back in 2000. We're at about 6.5, and then it kind of went down from there, and kind of leveled off with some changes. Went up a little bit, so as low as 4% to up to 6%, and then it just continued to go down from there. So we do see here in 2009, so more than 10 years ago, we've got a very solid sort of basis of where the variable rate has stayed. It's pretty much has gone up as high as 4% and as low as oh, I lost you there. There you go. As low as just over 2%. So we can see that there's not been a lot of variability in the variable rate, really. When you think about it, right? Sorry to use that pun, and maybe I didn't. Hopefully, I didn't steal your thunder, Matt, on that one. I know you like the pun.
A good one. I love me a good pun, and you got it. That was it.
But basically, yeah. I wanted to show you guys this graph, because really what we see is that we do see the media pumping a lot of information out there about raising interest rates, but you can really tell that over the last 12 to 13 years, we have not seen a lot of fluctuation. Okay, so we will see some fluctuation, but it's not going to be relative to what we've seen in the past, not going to be huge. Okay, so that's sort of how that works. So two things to take away here. Bank of Canada makes the changes on the overnight lending rate. That then reacts to where the banks together, although they're supposed to operate separately, all operate at the same page, and you'll usually see RBC will raise the rate or lower the rate based on what the Bank of Canada does. So if the Bank of Canada raises a 1/4 point, they will typically raise prime a 1/4 point, and then all the other banks and lending institutions will follow and do the same thing. Okay, and why I say RBC is because RBC is the largest bank in Canada, so it's usually RBC or TD, one of the two that announce first. But in the end, they all follow and do the same thing, and that's how it works. Okay, so that's important for us to set this foundation, explain to you guys how that's going to work. Okay, and why it works this way. Okay, so now let's chat quickly, Matt, move into what are the advantages of the variable over the fixed?
There's definitely a few. Well, I think we'll highlight three in particular, the three that we probably see with the most consistency in what we see people, we see our clients at least taking the most advantage of moving forward. So first and foremost, obviously goes without saying, you get into variable rate, at least as that chart has just recently shown, and the interest rate is lower, meaning that the interest savings is increased over the course of your term. What this means is for most of us, greater cash flow. If you're going to have a monthly payment that is effectively lower under a variable rate mortgage versus a fixed rate mortgage, the idea there clearly is that there is increased savings every month. And we'll get into what that could look like and what you might want to do with those savings as this meeting progresses here, and might shed some light on things that might be more helpful in realizing why variable is continuously the more advantageous between that and a fixed. Number two, flexibility. I think talking to Vince leading up to this today, the one thing that might be more important now more than ever is the idea of having flexibility across all spectrums of one's life, for goodness sake, but certainly financially speaking, when we're talking one's largest liability in the way of their mortgage, flexibility is king. And so when we're talking in the way of penalties, which we will certainly shed some light on as well, that's going to be an absolute strobe light of a light that gets shed on that one later on within the meeting. But penalties, when we're talking about penalties on a variable rate mortgage, it's relatively simple. It is 3 months of interest over the balance of the mortgage amount, and that's it. It is predictable, it is consistent, and it's a very quick calculation, as opposed to a fixed penalty, which has got a healthy little algorithm behind it that is different slightly between each lender. But the rule of thumb is that it's anywhere from 8 to 10 times more than the penalty that's served on a variable rate. And depending on what that rate looks like, it could be handcuffing, right? It could be the difference between purchasing that home, doing that extension, investing in that new business, or not, as a means of being able to get out of the current mortgage cleanly, or a little bit cleaner versus not doing so. And then obviously having repayment options are still important. So if we're talking about being in a variable rate mortgage, you have the advantage of a lower rate, of increased cash flow, having the flexibility, all while not compromising the idea of any given point having repayment capabilities, in some cases of upwards of 20%, that you can still make along the way. So you take advantage of the lower payment while at the same time doing a number on the principal should you choose to along the way as well. Not much to really lose out on, and from what we see typically with a variable rate mortgage.
Yeah, no, definitely. Of course, we're huge proponents of the variable, so we do definitely practice what we preach. And of course, having seen so many different scenarios, of course, clients coming to us at some point if they are in a fixed and having to make a change, a lot of them are shocked by the fine print of the mortgage that they're in. So they've been hit with massive penalties, and we do see those as we simulate them. And then, of course, it's not to say that a variable is for everyone, but we do feel comfortable with the recommendations we've made, and going forward still feel very comfortable with making recommendations on the variable today for those same very reasons you mentioned, Matt, right?
Absolutely.
So let's look at numbers, shall we? Okay, so let me share this screen, and I'm going to show you guys the calculators that we put together. Now, we've had to make some assumptions. Okay, so this is the calculator. You guys have seen this calculator before. Oh, look, Nick put Vince as the client name. Okay, so I'm the client. Here we go. I've got a value roughly of 800,000. This doesn't matter really. Really, what matters is a loan amount. So we've chosen a loan amount of 600,000. Okay, now that can be plus or minus for so many people on this call, so it's really hard to say. We just chose an arbitrary number of 600,000, and then we'll give it to you per 100,000 in a minute. Okay, just so that you can scale it to your mortgage, plus or minus. And what we're doing here is we're running the numbers on a variable rate mortgage. So variable rate mortgage at 600,000, and if your contract rate, so this is your net rate, is 2%. So right now, prime is 2.7. So if you're at prime minus 0.7, which, some of you are at better than that, but let's just say prime minus 0.7, you're at 2%. Then that would yield a payment of 22, 15, 23 a month. Okay, that's essentially what that person would be paying. Now, someone today would say, okay, what do I do? Do I flip into a fix? That's what's happening right now. We're receiving many phone calls from clients saying we want to flip into a fixed for security. Okay, and really now let's simulate what that looks like. Right now, we have a client that would be giving up 2% of a rate to the largest increase in fixed rate, in the spread between the fixed and the variable roughly is double. So that same mortgage amount to be fixed today is roughly at 4%. Okay. And so now the client would be giving up a payment of $2,215 to pay $2,853. And so we're seeing that. And so that's a spread of $638, Matt. So we do see that it's a lot of money on a monthly basis.
A lot of money.
And if you were to annualize that, it's about $7,600. And remember, folks, it's after tax, right? So this is a net dollar, extremely expensive, high amount of money to give up. And that money is going straight to interest. So it's going right to the bank's back pocket, right? So very, very important to look at that. So we always want to point this out. This speaks to Matt's first point about saving on the payment. So we can see that that's a huge difference.
And this is to service the same loan amount. This is the same $600,000 over a 30-year amortization. It is apples and apples. The only difference here, and it's a healthy one, obviously, is the interest rate, but that's realistic. I don't think we've inflated any part of this that isn't what we're seeing on a regular basis now. 2% is typically the delta between variable and fixed right now, and it equates to $650 difference per month after tax money.
And a little sidebar to that, guys, is that this is one of the largest spreads between variable and fixed ever. Frankly, larger than what I've seen before. So there's a big jump, right, to go to get some security or perceived zone of security on the fixed mortgage versus variable. So that's one big thing we can see. Okay, now let's look at the other thing to keep in mind. What if rates go up? What does that do to this payment here, $2,215? So let's have a look. Okay, if rates go up a quarter point, which is typically what they go up or down, but we will simulate 50 basis points or 0.5%, because we are hearing some chatter about that potentially happening on Wednesday. So let's take a look. So we go from 2% to 2.25%. We're going in payment of $2,215 to $2,290. That's a $75 difference
Per month. What happens if you put it up another 0.5 point?
Okay, let's have a look. 2.5. It's another $75. So it's $150 a month.
Yeah.
Okay. So $150 a month. That's the $150 digging into the $638 difference. Right?
So still net almost $500 per month on this scenario, between variable rates potentially going up another 0.5 point versus where the fixed rates currently are at this stage.
Correct. You got it.
Yep.
Okay. All the while you're still saving that amount of money.
That's right.
Okay. So very, very important. Now, what we've done is we've broken it down. Just looking down here because I took some notes and made some notes. So if you want to do this per 100,000, so here's the idea. For every $100,000 in mortgage that you have, a 25 basis points or a 1/4 point increase, so that means 2.25 from 2, means a payment increase of $12.50 a month. So if you have a $300,000 mortgage, that's $12.50 times 3. That's the increase, right? 30, what is that? $37.50?
$37, yeah.
Yeah, $37.50. So a month, that's the increase. So per 100,000, $12. Okay, if you're on a bi-weekly, it's half that. Per 100,000 is $6 every 2 weeks. Okay, so that's the difference that we're looking at, and hopefully that helps you scale it to your individual situation. Again, we're here to talk individually if we needed to. Any questions on this at this point, Matt? If not, we're going to go into mortgage penalties, because I want to show you guys this.
I think this makes sense, but yeah, the penalties, I think, is where it's going to really draw the line in the sand and let everybody know.
Okay, so let's look at the same mortgage. So 600,000 if we were to break it. Okay, we made a simulation. Again, we're saying, so the average Canadian, believe it or not, about 70% of us are breaking mortgages within 36 months, 24 to 36 months. That's the ratio right now. Okay, so people are paying penalties like crazy. In November of this past year in 2021, the percentage of clients going into variable rates had reached historic highs. Over 50% of Canadians were choosing variable rates versus fixed. And obviously because I feel like there was a huge difference between the variable and the fixed. So there's a bigger delta, but also I feel that people are getting a little bit more informed because people have been getting burned with these massive penalties, right? You're selling your home and all of a sudden you get hit with a huge penalty. I mean, last year, I think the largest one I saw was about 80,000 on a pretty large mortgage, but that's a big amount of money to swallow, right? And just hand over to the bank. So I'm going to show you $600,000 mortgage. Let's change the share. I'm going to share this screen here. What is this? This is the variable. Is this the variable? This is the variable. So let's share this one. Share. I want to choose the right one. I don't want to. There you go. Okay, I think I got the right one. So here's the variable rate, 600,000. This is taken from one of the calculators from the banks. Okay, so of course we concealed the which bank it is, but we just basically went with $600,000 mortgage. It's a variable rate. We have 36 months left in the term. We're at a 2% interest rate, like we showed in the simulator, and we've got a penalty of $3,000, which is essentially 3 months of interest. Right? It's a straight line calculation. It's predictable. So anytime from now until the next 36 months that they break this mortgage, it's 3 months of interest. That's it. Okay. Lowest penalty calculation in the industry, other than an open mortgage, which is, if you don't know, an open mortgage just means that you can break it any time, but you actually pay a significantly higher rate of interest throughout the term. Okay. For you to have an open contract. So let me go into the fixed. So the same mortgage, if it was fixed, change this. There's the penalty. Do we see it? So again, 600,000 fixed rate mortgage, 5-year closed, 36 months left, current interest rate at 4%. 2% rate of interest is when you is what the discount you got. And it's a $32,000 penalty to break that mortgage. So significantly higher, falls in the 10 time range. I've seen it usually about 8 to 10 times the variable rate penalty. So whatever you would pay in a variable rate, you're going to pay about 8 to 10 times that to the bank. Why do the banks do that? Well, essentially a fixed rate mortgage, you do get security, right? So there's almost like an insurance built in, and that insurance doesn't come for free. You get it by obviously paying for a higher rate of interest, but also the bank is securitizing that rate and that cost differently than they do in a variable rate. And if you break that, essentially what you're saying is well, you gave me the security and now I don't want it anymore. So the bank hammers you with a penalty. And so therefore it becomes what's called an interest rate differential penalty. They're saying, well, now that you're breaking the mortgage, I'm no longer going to be getting the interest from you that I was guaranteed. So I am going to collect this interest from you based on the differential of what I would have collected from you from now until the end of the term. And I'm going to collect it now up front. And then I'm going to lend that same amount of money and lend it to someone else and collect interest on top of that. So that is banking, and that's why the banks are very, very successful in terms of financially successful, and their penalties are significant, especially on the fixed. So you can see. Anything that I missed on this, Matt, or that you wanted to add on this?
No, I mean this makes sense. I mean, you ask why these banks do it, and there's about 32,000 reasons there at the bottom of the screen that they want to do it. So yeah, I mean, you make reference to these numbers, and it's staggering stuff. Where if 50% of people are doing variable, then it means that 50% are still doing fixed, and if 70% of those 50% are breaking their mortgage, then these are the breakage penalties that are being incurred way, way more often than what any of us might think. So the idea of breaking your mortgage is not a bad thing, especially if there's greater opportunity to put or to do something different. There is definitely such a thing as good debt. So that's not the issue here. It's, can we make smarter decisions before getting to that point, and keeping as much of your own money with you? Ultimately, keep it in your pocket. Don't pay it to the bank if you don't have to pay it to the bank ultimately.
Yeah, and I think one thing if you're considering going to fixed, what I always tell clients who've called us so far, and I'm sure you've done the same, Matt, as we've talked about along with others on the team, is in this scenario, you're accepting $638 increase in payment, and you're accepting to pay a significantly higher penalty, which will be likely about 8 to 10 times should you break your mortgage within the next, in this case, 3 years. So you're going to pay more on the front end and then definitely more on the back end. And this is where it really is important for people to realize that, because many Canadians today that are just choosing a fixed or choosing to flip into a fixed don't understand this. I can tell you right now, because there's the level of the amount of due diligence and education that's being pushed out there to clients in general on the financial literacy around fixed versus variable rate mortgages doesn't equate to the amount of fear that we see right now being pushed out through the media right now with regards to what's going to happen with rates. And no one really knows. We don't have a crystal ball, right? So all we can do is provide you this context and this information so that you feel comfortable and are in a better position to make the right decision for you and your families. So what do we do? What are we going to recommend? What do we recommend clients to do? So people on this call, what do we recommend you to do? So Matt, I'd like you to start off with some of the recommendations that we're giving clients who are calling us these days. So go ahead.
So, I mean, one of the first things that we would talk to right off the hop, you made reference to, is asking where some of the information is that they've gotten up to this point, and taking everything with a grain of salt and taking everything as balanced as possible as well. And the idea of going fixed is not the worst thing in the world for some people. If it allows them to sleep well, or to be able to wrap their head about knowing exactly where they're going to be every month, because that's the be all end all, then we're not going to be here to kind of dig our feet in the sand and tell you the opposite. If that's what works for you, so be it. All that we ask is that before you make that decision, you determine that the factors leading up to that decision, wherever you get them from, are valid, that they're strong, that they make sense for you and for your family. That's number one. Number two, I know that we have always, at Meta at least, we have always worked with you as our clients to determine what your plan is from the get-go. Before we do anything in the way of submitting for any type of an approval or a refinance of any sorts, we want to know what the long-term plan is. What is it? A 2-year plan? Is it a foreseeable future plan? Is this something you're going to flip? And these are all things that we want to be as on board with you as possible. And we want to then look at this stage in the game, when there are changes potentially coming down the pipeline with variable rates, with what, if anything, has changed in your plan. And if something has changed from a budgetary perspective, or if you put greater weight on other things now than what you did maybe when we initially had set up your mortgage, then certainly we can look at reassessing at what a potentially different mortgage strategy could look like for you. There's also different types of rate packages that are not all one or the other. It's not all black or white. It doesn't have to be variable, it doesn't have to be fixed. There are options that are out there that provide hybrids of the two. And that might be something worth considering. And again, like everything else, it's not all pros and no cons, or vice versa. It's just a matter of knowing that these are other options that might be able to bridge the gap of sorts.
Yeah, absolutely. So, we're really plan oriented. So ultimately, people who are calling us today, like I had a call yesterday with a client who talked to me, or sorry, it would have been Friday, talked to them. And basically we're talking and I had to go back into the file and understand, okay, here was the plan. You only plan on living in this place for a certain amount of time. Has that changed? So we kind of revisited the plan, and everything kind of made sense to still stick with the current plan, which was the variable rate. But there was still that feeling of fear of, but I'm hearing this on TV, and I'm afraid that this is going to happen. And that's okay. We're here to talk it through. But once I broke down the numbers for her, she realized, okay, I guess it wasn't as bad as I thought it was, right? So it's important to know that you can reach out to us. We're here for that. And if you want to discuss your individual plans and situations, we're here to do that. We want to hold a call like this so that we can really open it up and get into that sort of, that discussion in general. But we can do that individually as well when it comes time. The one thing we've done, which I don't know if this has been coined or has been patented or anything like that, but this is a little bit of a recommendation solution we've done and told people to do. And I really hope people do it, because this really does make a difference. Okay. My thought is this: if a client is willing to pay $638 more a month for the security of a fixed rate. So let's go back to that scenario: $600,000 mortgage, you were paying $2,215 and you're willing to pay, I forgot what that number is, but $638 more, okay, for that security. If you're really willing to do that, what I'm telling clients, Matt's telling the same thing, and our whole team is telling clients today, rather than give that money to the bank, okay, stick with the variable rate and take the same amount of money, $638, open yourself up a savings account and put that money into the savings account. Okay. That alone, on an increase of a quarter point, which is going to change your payment by $75 going forward, that $638 is good for 8.5 months of that payment increase. Okay. So if the rates go up, you now have a little piggy bank there, right? Every month you're putting $638 into it. If rates go up, you have the money there to cover the increase. Okay. It's going to take a heck of a lot of increases for you to eat that or consume that amount of money on the side. So rather than giving it to the bank, take it from one pocket, put it to the other one. So one checking account, put it to the savings account, and leave it there for the rainy day. If rates don't go up to the point where you're going to need all of this money, then you've got additional funds aside. You can use it as a prepayment against the mortgage, and obviously double down, or you have a rainy
vacation.
Or what's that?
Let's go on vacation.
Or vacation. Yeah, that's right. Everyone needs a vacation.
It's gonna be a healthy fund really quickly all of a sudden.
It will, right? Because rather than giving a $7,650 a year to the bank of after-tax money, that's money that you've kept aside. And okay, granted, it might not be $7,656 at the end of the year, because there could have been a few increases, but it's certainly not going to be in the hands of the bank, and it's going to be still a significant amount of money that I would rather keep in my pocket rather than give it up.
Yeah.
Right. So that's one of the recommendations we're making to people. There are other recommendations, as Matt said. There are other variable rate type mortgages that we can look at, like variable with a fixed payment and so on and so forth. But regardless, I guess our message here is, let's take the information that's out there with a grain of salt. Feel free to reach out to us, to ask questions, to run some scenarios by us, and we're happy to sort of break it down on a spreadsheet and numbers wise for you. And then ultimately, if whatever decision you decide to make is going to be the right decision for you and your family, we're here to support you through that. Okay. Any questions from anyone? Okay, so what we're going to do is, again, this is the first time we've done this. Hopefully it was informative for you. I know this was fun for me, Matt. I think it was fun for you too. We had a good time.
Yeah, this is great.
Okay, this is great. So if what we're going to do is we're going to send out to everybody on this call, we're going to send out contact information as well as a link to book. If you wanted to book a 15-minute chat or half-hour chat with anyone, you can go ahead and do that. If you have some questions, just email us. Okay, we're here for that as well, and help you out through this time. And then of course, our phone number. So if you need to get a hold of us, just give us a call, and we're here to help you anytime.
Definitely.
Okay,
lovely to formally meet all of you guys and ladies on the call here today, and just echoing Vince's sentiments. If there's anything that we can be helpful with, don't ever hesitate. It's what we're here for. We love doing it.
Excellent. Thank you, Matt. I really appreciate your help today. It's been great. I'm happy that you got to meet everybody, or everyone got to meet you.
Yeah.
And I wish everyone a great afternoon.
Have a good day, guys.
Thanks, everyone.
Bye.